I found out my company is moving its 401k from T. Rowe Price to Bank of America Merrill Lynch. I did a quick search and only shows me bad reviews of Bank of America Merrill Lynch. What are your thoughts? Question mark. So that's a good question. It's a big question, and it's an important question. And lots of people have, or people who work for employers, private employers, often have a 401k. If you work for public government, federal government, you'll have a thrift savings plan, which is the 401k equivalent. If you work for a school, you'll typically have a 403b. If you work for a local municipality, you might have a 457 or 401a or something. Super high level, they're functionally all the same. It's a retirement investing / savings plan your employer sets up for you that you can contribute to. They may contribute something as well, but the intention is you put money in and you invest it and it grows. And over time, eventually you take the money out. There are rules around when you can take it out, how it's taxed, etc. I won't get into that. We've touched on that in various episodes before. But the crux of the question is, the 401k has moved from whomever to now Bank of America Merrill Lynch. Is that good or bad? What are your thoughts? Generally speaking, it's not good or bad on the surface. You have to dig more and look. It's a large, well-known name. So if nothing else, that you would think has some positive check marks versus some no-name scrubby company no one's ever heard of as the administrator of the plan. So good on the surface so far. But you really have to look as the plan participant, as the employee using the 401k, you really don't have any choice. The employer picks the plan provider for you. Now, you could potentially be on the committee that helps the employer decide on who to use for plan administration, what features the plan is going to have, et cetera. But generally speaking, most employees, you're not at all involved in that. They just kind of tell you, here's the 401k. Do you want to participate? Yes or no? If you do, here's your investment options, whatever. So now Bank of America Merrill Lynch isn't inherently bad. And I frankly don't know anything about them in particular as a 401k administrator. As financial advisors, Merrill Lynch financial advisors, I have my thoughts. I won't really touch on them here. But as a 401k, you have to look. There's a few things you want to look for. First and foremost is what investment options are available to you as the plan participant. Now, most 401k, well, not most, but all will have some predefined menu or roster of investment choices you can choose from. There'll typically be a host of index funds, like funds that seek to track the S&P 500, funds that seek to track a small stock index, funds that seek to track some sort of international stock index, a few different bond funds, and then you might also have actively managed funds from different brands or companies. I won't name names, but there's almost infinite combination or fund companies out there who try to offer their products into institutional plans like 401ks. So you might have some various bond funds, various stock funds that are actively managed, where fund managers are trying to pick and choose specific stocks or bonds they think will do better than the broad index. Hence, you might want to go that route as opposed to just invest in the passive index tracking funds. But generally speaking, I'm not a fan of actively managed mutual funds. I think passive is all most people need, lower cost. A lot of research has shown passive generally outperforms active management funds, especially net of the higher fees of the active management funds. So go, check the investment options available to you. For all intents and purposes, most people really don't need more than 3, 4, no more than 10 funds in their 401k. Some basic low-cost index funds, a few different stock funds, 1 or 2 bond funds. That's really all you need. If you want to be super hands-off, there's target date funds or target date retirement funds where one fund bundles in underlying stock and bond funds, and they tweak the allocation along the way as you approach retirement. I did an episode on that. I'm not saying those are good or bad. Some people have very strong opinions about target date funds. I'm just saying they're an option, and they are common in many 401k plans as offerings to you. But check the fees. So almost certainly you're going to have a decent enough choice and variety of stock and bond funds. Again, most people don't need more than a few available to you. Anything beyond that's really kind of unnecessary complication. But so you probably have access to decent funds, but check the fees. Technically, I don't know if you heard that. I'm in my office. There's a monster storm going by. I just got a large strike of lightning outside, loud thunder. But check the expense ratios of the funds. Typically, index funds like stock index funds, S&P 500 index funds, the expense ratio is usually going to be 0.05% or lower per year. Actively managed funds will typically be 0.5%, sometimes higher, maybe a little lower, but figure 0.5% to 1% of expense ratio per year for actively managed funds. Again, you probably don't need that. Fees matter. If you can pay 0.05% or less per year, all else equal, you're going to have, whatever 0.5% drag just in fees if you were to instead pick the actively managed fund, because right out of the gates, that fund needs to produce at least 0.5% better every year than the passive fund just for you to get the break even. So check the funds available, check the fees. Those are probably the most important things. Other big important thing is the participant administration expenses. And these can go by different names and different structures of how they charge you. But in addition to the built-in fees of the funds themselves through the expense ratios, and those expense ratios get deducted right out of your balance in the fund. You don't actually like see them come out. They just sort of get taken out by the fund manager. So they're there, they're coming out. You just don't see them necessarily. But the plan administration expenses are something you will see come out. Depending on the plan, it could be a fixed dollar fee. It could be a percentage of asset fee. Many large employers, it's quite small. It'll be like tens of dollars a year you're paying an administrative fee. Maybe it's like $15 a quarter or something. I don't know, give or take. And you'll see that come out on your statement. So check what those fees are, know what they are. Just so you know, are they a lot, are they a little? And a lot are a little relative, but without knowing what they are, you have no idea. So how do you find out these fees? Dig around on the 401k website. There should be there somewhere. It could be under different names. It could say fee disclosure. There should be something called the summary plan description is good to look at as well. That will tell you the features and functions of your 401k. Can you take loans? What are your distribution options, et cetera? But check for something that details the fees, not just the expense ratios of the funds, but the fees of the plan itself, so you know what you're paying. So to come back to the question, if you have funds available with low expense ratios, very good. If you have low plan administration expenses that you pay as a participant, again, tens of dollars a year is what they shake out to, very good. If it's much more beyond that, then you need to question it. But again, you don't really have a choice because your employer picked Bank of America Merrill Lynch. Now, to be fair, if it's a large employer, hopefully chances are that they did this homework. They're not going to stuff you with an unnecessarily high expense plan because they do have a fiduciary responsibility on behalf of the participants to not let you get taken advantage of with the plan provider they choose. So not to say your plan is going to be the cheapest out there, but it should be reasonable and fair fees. It should not be egregious or unnecessarily high. So check the fees, check the fund offerings, et cetera. There's going to be other features and functions that may or may not be of benefit to you. Again, if you need to take a loan, do they allow that? They probably do. What are your distribution options when the time comes, et cetera? Here's another biggie, particularly with Bank of America Merrill Lynch, because Merrill Lynch is an advisory firm. You might have access to advisors at Merrill Lynch through being a plan participant. Now, maybe that's a feature you want, maybe it's not. If it is a feature, look into the cost. Is it free service and guidance you can get from Merrill advisors, or do you have to pay? If you have to pay, how much is it? So then that's something else you have to weigh. So I'll leave it there. I think those are the key considerations. The plan isn't inherently good or bad. There's other things on the periphery I should have said, like the website. How good is the website? How easy is it to use? What's customer service like if and when you need to call up and do a rollover or whatever? Those are other things that matter. Again, you don't have a choice. They are what they are in the plan. But those are things you may want to look into, or at least I guess cross that bridge when you get to it, right? You'll know how customer service is when you need to actually pick up the phone and call them. So I wouldn't be worried about your plan switching to B of A Merrill as the administrator now. Again, just check the fees and whatever. If things are unnecessarily high, maybe don't use your plan heavily, like don't put in more than what employer match you get. Maybe instead invest outside in another option perhaps. So that's that. Great question. Thank you very much.